Everybody, great to have you here for our growth and value webcast today. Mike Fairborn sitting in for James Boyd, who is out. He is vacationing in Oklahoma. And by the way, a very nice place, I have to say. So it's good to be here with you today, folks. I wanted to lean a little bit more towards the value today. Still considering the growth concept, but tying together really a value approach that has been used previously and introduced by a very famous sort of money manager in the past. I want to talk about that in more detail. It's very simple, but very straightforward and actually very interesting in terms of evaluating companies based upon their growth prospects plus their income, which is really fascinating as well. So I'll look forward to going into that in detail with you. Hello to you, Jay Richardson. Welcome. Good to have you on board, as well as Olga. We've got Aller Dom. How's you doing, Dom? Will, good morning to you, Will. Robert, BJ, Josh, welcome. Folks, very sorry JB is not here today, but I'll try to put on a good show here for you. Just a really cool formula in terms of valuation of a company. Is it undervalued? Is it overvalued? Is it attractive? Is it not attractive based upon growth plus income divided by what we're actually paying for the stock right now. So some references there. I look forward to it very much. But let's do this. Let's go ahead and jump into our disclosures to get going here. So the information here is for general information purposes only. Paper money software application for education purposes only as well. Now, there are risks associated with investing in dividend paying stocks. Important because today we are going to be talking about those, including but not limited to the risk that stocks may reduce or stop paying dividends altogether. Now, investing in stocks involves risk, including loss of principal. Past performance is no guarantee of future results, and there's no guarantee uh, that execution of a stop order will be at or near the stop price. All right, so having said that, let's go ahead and just pull up our charts over here and take a look, just big picture at the markets as we get going here. Welcome to you, Sharon, just joining us, Gary, Austin. We've got Mark, as I mentioned, Dom, and others in here. Sam, welcome everybody. Oh, let's see. We've got this from our swing trade class yesterday. I'm gonna go ahead and take this off. In fact, I'm just going to update this to the daily 35, and we'll go into the S&P 500 index here. Now, one thing I did note on the S&P, just a super quick note, is just getting a bias, just getting a general feel for where market direction could be headed, where it has been right now. A lot of times we will use patterns to help us with this, give us a general idea. But what is fascinating for those of you that, and some of you are, many of you are, Will, others in this group, Jay Richardson, and others, Dom. We did take a look at this yesterday in the swing trade class, and this is interesting on the triangle pattern, which is noted for lower highs and higher lows, that consolidation range. Drawing off the closing values, which is what I generally tend to do on these patterns here. But you'll notice, and this is very sort of common, you'll come back down, you'll break above maybe the channel line, but you'll oftentimes come back down and find support there where you may end up bouncing. You may or you may not bounce from that level. I wanted to highlight this just to show you the projected number here too for that triangle. It is interesting because, as I've been mentioning in the swing trade class and the ThinkScript class, that it does kind of put us into that mid-August to later August, referred to as the good old summer. Oh, is that enough M's? Probably. Summer rally range. I have to put a question mark there. We don't always get the summer rally, but when we do, a lot of times it's noted for start of July to August and up to August to mid-August to the end of August. Folks, for those of you that haven't seen this before, I'm going to show it. I know many of you in my other classes have seen it, but just real quick under style, standard, seasonality, you can check that out and just see last 5 years, 10 years, 20 max levels. Where have we been? I'm going to make this more comparable by going to a percentage chart, but this is really a depiction here of the average of the S&P 500 over the last 5 years to kind of help show you where that summer rally range can occur. This one came a little bit earlier, granted, about mid June. but you could see the rally time frame. And we don't know. I mean, that triangle could slip in to that range and we could see some move here. So there could be a bullish pull. At least from a technical perspective, a lot of technicians, I would say, by the way, I'm going to hit that 10 here real quick under the daily. You can see right there. Yeah, a little bit close. So yeah, oh, there's your beginning of July, kind of rally to August. But this has kind of been noted for a move. And before you get kind of this fall pullback in the fall. But keep an eye on that. We'll see how that does play out in terms of the general market. Let's go back. It's just always going to go back to the stock that I've saved in this grid, but back to the S&P. Yeah, trend up, generally favorable, you might say, very likely. I'd say to a lot of technicians. Trend up, flattening out, triangle, break out of the triangle, testing the triangle, maybe still within that. Can I highlight it? Yeah, summer rally range, question mark. We don't know. Every year is going to be a little bit different, but on general, you just saw what happened with seasonality, and on in general, on average, we can say 5 year, 10 year, 20 year. I've seen longer where we get on average. I keep going back to that because any year can be different, but you can get that general movement here. And it does kind of fit with the technical trend and otherwise here. Okay, got Mari and Ron and others joining us here. Welcome. Hello to you, Riceberg. Yeah, hey, no, no worries. Good to have you here. Whether you're late or not late, it's always great to have Riceberg here. Let's be honest. All right, let's do this. Let's go ahead and let's dive in now into a concept developed by a famous manager, money manager in the past, Peter Lynch. You've probably heard of him before. We're going to add a little bit to this. I'm going to show you how to tap into these results here. But what Peter Lynch did, and he looked and devised. I'm going to do this. I'm going to go ahead and just pull up a what I'm going to do is I'm going to pull up a sheet, which JB does a lot. But we're going to be looking today at really a valuation approach using a Peter Lynch valuation. And this is one that he talked about within his books, plural. He referenced them. He referenced them across a number of different sort of formats, though. I'm just going to say that people that may have gone through some of that material may be able to understand that. I'm not just highlighting a specific book here or anything like that. I'm just saying generally this was his approach that he had discussed quite a bit. And this is what it is in terms of valuation. Now, Peter Lynch was big on also looking at a company's dividends too. But this was the general approach used. And basically, he was just looking at future growth. We can bump this up in size. We don't have to stay small like this. Let's go ahead and just, you know what I'll do? I'll just highlight this entire range. Yeah, well, that's kind of big, but that's fine. Future growth of earnings, and we know that we're dealing with publicly traded companies, so it's earnings per share. All right. JB talks a lot about this, I know, and for good reason. There's a lot of things going on here with it. Sorry, I'm going to bump this back down a little bit. I'm going to get this all on one line. Still big, but on one line. There we go. And I want to add something in here, and that's going to be the dividend yield. In other words, there is value that an investor is receiving in the terms of growth of earnings of the company, plus the dividend income that is also being received. Now, this approach is a little bit more geared towards companies that do pay some dividends. A lot of technology stocks do pay dividends now too, as you, I'm sure, are well aware. But with all this, we want to add that component in. This is kind of like the growth portion. It's combined though, because it is a form of growth that the investor themselves may be getting from those dividends. We talked about how they can be cut at any time, right? But a lot of them have long histories, particularly in the S&P 500, where you're going to get the dividend aristocrats, 25 years or more of consistent, every single year raising the dividend as a dividend aristocrat. And we're going to be scanning through the S&P 500 using some of the Schwab capabilities here in just a second. But we want to take all this and we also want to divide this by, I guess I could put a giant line under here, right? Could do that, like that. Oh, and just say something like a PE ratio. What are people paying right now for earnings? What are they currently paying? That's what we're really going to be talking about today. And I want to develop this and kind of talk through it in an Excel type format, but it's going to be very, very basic. These are not Excel classes. There's only just one simple formula we've got to do. But Schwab is really nice because it takes that information and it plugs it in here for us. Now, we're going to take a look at these components here. What are going to provide us these results, but what we'll be ultimately looking at here are the results that are kind of like, if it is less than one, then we're going to consider this not a great deal. Not a great deal. That's going to be overvalued relative to what we're paying for it. Okay. One, this is the Peter Lynch scale, by the way. It's not my scale, it's his scale. 1 to 1.5 is going to be fairly valued. Oh, Fairborn. That popped in. That's funny. All right. It filled in, autofill. All right. Fairly valued. Um, Nearing two, I could say like something like this. Approximately two range. I'll make it two range is going to be generally undervalued. Let me get these dashes in here just to make a quick separation. Yeah, so it's similar to what we got up top. And then this is what we're looking for. Three or higher, you guessed it, it's going to get the very undervalued range. Okay, this is the ratio. This is the relationship. Now, I write this formula out right now because I wanted to give it to you. So on your existing stocks that you might be looking at, maybe they're in your portfolio, maybe they're just paper money stocks, whatever the case might be, you can run through and just get kind of a general feel of where it fits based on how he views valuation. Now, obviously, what does he do here? What did we talk about in this class? James talks a lot about this as well. I mean, on one side, yes. On one side, absolutely. We've got the fundamentals, right? We got the fundamentals here. We also have the technicals. And when I just visualize and I think through this, folks, I think about this three or higher or the very undervalued range. I'm trying to visualize kind of like what is the most interesting scenario here? Well, first of all, from the fundamental aspect, gosh, it'd be great down here. And why is that? Because we probably do have a growth driver right here that can lift us and make it more attractive to those that are seeing or looking for maybe those opportunities out there where the price is not too high. If you have solid growth and the price is not too high, maybe there's a tendency for a stock to rise up to those higher levels, right? There could be a driver there. And what I kind of visualize is this, the trend of a stock. So I want to see something undervalued, but also a company that's, trend, maybe showing an upward trend or starting an upward trend. It might very well be low because it's done one of these. It has, let's do this in red here. It's gone down, 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 and all of a sudden it's begun to turn around. Growth can do that. But also, if it's undervalued, you might see somewhat of a driver there to get that trend back up. That's the whole, I mean, that's what really, when we think about this, it could be of huge, huge use. So let me just do one thing here. Boom, there we go. All right. So let's jump back to this. And I'm going to go right into Schwab. And I'm going to start from scratch and I'm going to go through these. So we've got just right from the get-go, right on schwab.com, something you all have access to here. Okay, in the stock screener. So I'm on Schwab right now. Go into your stock screener. You might have other screeners, but this I think is a great one to use. I'm going to use the basic one here. I'm just under research and then click on, I clicked on actually stocks and then research. And then it took me to research. And now from here, let's go right into the S&P 500. Okay, many of these companies do pay dividends. Here's the index. Here is, in fact, the 500 and three. Sometimes that does vary, but 503 stocks that fill that in right now. So let's go ahead and point this out. Now, when I did say projected, I mean, when I said future, I didn't say guaranteed, right? I just said expected. Projected. This is a projected earnings growth, EPS number. So we're going to tie that in next, and we'll go from here. We're kind of building, today to kind of answer Paul's question. It's a script it's really done in Excel, but there are some codes behind, I could say a formula behind it, but I'm gonna label that so you all have that today, so you can, because I think one of the keys is here, kind of to Paul's point, and this is kind of nice with scripts, is you get to scan the entire universe once you have that concept down. Now, I did show you this initially because I did want you guys to utilize this on your existing kind of portfolio. It's really cool. It's really concise and straightforward. But one of the, I think, great opportunities, it could be an opportunity, is to be able to take something like that and then expand it out using Schwab tools here. So let's continue on here. Under the specific criteria, let's go ahead and go down into company performance. Now scroll on down. We need to get to that projected number, which is going to be right here. So this is an estimated, same thing as projected, same thing as future. It's an expectation that we're getting from these companies, a lot of times from, it's from the individuals that follow it, the brokerage firms, etc., the analysts that are giving those numbers, but a lot of times they're tapping into what they're getting and referencing from the executives of the company as well, right? So they're trying to formulate this information right here, a 3 to 5 year, and that matches exactly what we're after. That's the future growth rate. We're going the longer term one in this case, okay? So we've got that up top here. Next thing is, let's go right into the dividends right there. And we're going to choose the third one down, the annual dividend yield. Let's click on that. Okay, and then lastly, so this is the growth component. Remember, we're using this as a guide to add to that growth in terms of dividends. Then lastly, what I want to do is I want to go right into valuation and just select what the company is being valued for in the marketplace relative to its earnings. Now, I'm going to keep this one. Actually, no, we're going to adjust every one of these. I want to make sure we've got this. So our list is going to be a little bit more refined. So we don't have a lot of non-values coming up in the Excel spreadsheet. What I want to do is go over here and just say that there's at least a 1% here. A 1%, it's going to be greater than or equal to 1. Tab through it. They're going to have a dividend yield as well because we are using that. We don't have to use it, and I can explain that too. But I want to try to get the most of what we've got. And this, I have to say, is really, if you think about it, folks, this is really the hidden component right here that's oftentimes not mentioned in the growth side. Okay? It's not mentioned. What's behind the scenes? That is still something we are receiving. So Peter Lynch, he caught that. The other thing with the PE ratio, let's just make sure that it's positive. In other words, they have positive earnings per share. This is a great filter, by the way. Anytime you want to cut out companies that don't have earnings, just put it 1 or higher. Because by definition, you can't have a company that has, a negative number here and have actually, a PE ratio, right? In terms of earnings. So I'm just going to say greater than or equal to 1. Very basic. Look at that. Now we've narrowed this already down. So we've got 239 that are just going to make general sense in a formulation like this. Now, we wouldn't necessarily have to add the dividend yield in here, but I did want to do it because, like I said, it's really fascinating. It's that hidden component. Let's view these matches right now. Here we go. All right, so there you go. These are the ones that made the list. And by the way, many of them are paying. And that they have that second sort of bigger component behind the scenes, that income side. This is not going to fare too well, though, in terms of valuation with a PE ratio like this. We can scan through here and see what we've got, but it's also just awesome to see, what are analysts suggesting going forward in terms of growth? We set it at a 1. There's some of your ones coming in right there. Bunge and Brown-Forman. Um, let's go right now. Since we've got the data, we've captured it, we've done what we wanted to do there. We're going to export this right to a CSV. Okay. And I'll pull that up. It's going to show up here. Oh, yeah, there it is. Okay, so I'm just going to, it's been downloaded. Here it comes. So let's pull it up. Real straightforward, really basic here, but we want to find out what our results are going to actually be here. So a quick thing I'm going to do, they are all part of the S&P 500. So I'm going to narrow this down just a little bit. I like my description so we can see that very clearly. Let's kill this column. We know they're all S&P 500, so it's just kind of a redundant um, column there. Let's go up here, right between C and D. Mine went right into Excel. You might have something similar, but just right here, just double click when you get those double lines. It'll put this in like, well, you can just resize it or whatever. Just enough to put the EPS in there. Fine here, fine here. And then there's your PE ratio, price to earnings. You could put PE in there if you wanted to. TTM just stands for trailing 12 months, just so we're all on the same page here. All right. So what we want to do next, since we've got the growth side here, and let's do this. I'd like to make it nice and so we can see these a little bit better. Let's bold that out. Let's get this a little bigger. And I wouldn't mind if our numbers were a little bit bigger too, just generally speaking. In fact, I could just, what do we got? 230, 200 about 39-ish or so company. Yeah, that came up on our list. Just a little bit bigger here. There you go. So we can see those a little bit more clearly. I should have done my resizing just a little bit later, but that's fine. You guys get the general idea. There's your earnings per share estimated growth. Key point, it's a projected number. And what we're going to do, we're going to use this format here, this formula, to make our calculation off to the right. Because again, what we're going to be doing here is we're going to be adding these two together. That was the component we had talked about. For those of you just joining us, right over here, the plus sign, the plus. I'm going to highlight it because it is a big deal. There you go. That's big enough. We have to add this together. Now, we're going to put this over here, and I'm just going to put something like, just we can denote it as a projected value. Um, I'll just do, yeah, we'll do that. In fact, I thought that whole column was that. Let's see, 16. You got to highlight the whole column if you want to have it there, and then go to 16. There we go. So if I go over here now, it should just do this. I'll just say projected value. It's got to bold it as well. Yeah. Projected value results. All right, it's going to start right here. And this is the formula. Everybody ready? And these are in percentages, by the way. Important, you have to have these here. Oh, good question, Barb. So let's see. Barbara says, why did we put this in here? Well, I wanted to make sure if I had a zero in here, Barbara, if it didn't pay an annual dividend yield, then our formula is not going to work. It's going to say something like value. It's going to give like an undefined number over here. I put these in so they're all relevant to this valuation. Now, what we could do is we could simply just take our EPS growth rate divided by the PE ratio to get us a value projection, but it would be taking this out. So I'm just trying to make sure that everything over here gives us an actual value because the formula itself does have this component associated with it. Good question. All right, let's go over here. I'm going to go just equal sign, open your parentheses there, and we're just going to do this. Keep them exactly as they are through Schwab as percentages, because that's what they are. That's an expected percentage growth over that time frame, right? An average year-to-year growth over that long-term time frame. Just folks, simply when you got this parentheses in here, just click on the cell. What is the formula? Plus. The next click is going to be the dividend, so we can add that in to the mix. Now I'm going to go like this and just close those parentheses, and I'm just going to divide this by, hit divide side, divide by sign. The PE ratio right there and hit enter. Okay, so we get a number over here, but I'm looking at this as like, where does this fall in at specifically, right? Um, like, is this in 1%, 2%, 3, whatever the case might be? And we can put separate numbers in here, but I put it down as like a percentage in here. We can do a percentage, we can do a number. It's off And so I could change this. I made it a little bit easier. I'm just going to highlight the column, go down here, format cells. We could do a number, and I want to do percent. Watch this. So there you go. That's 1.7%. Folks, that is less than 1%. It's not a good number. If I go over here too, by the way, I mean, you can kind of decide because you're going to get certain numbers over here, different numbers. That even shows zero. We didn't go even back far enough. The percentages will kind of yield a little bit more data just using the 100. By the way, I could put a multiplier of 100 in here too, something like this in the formula. Maybe I'll just do that. Uh, so is that easier? We'll just do that. Okay, I had one. I try to keep it as simple as possible. I'll do this though. I just put multiplied by 100. So is that less than one? Absolutely it is. Let's make sure this column here is all of the same size. There you go. And that one actually 16. That's fine. Boom. All right. So there it is. It's 0.17. That's very, very low. Remember what we said over here. In fact, let's just do this. I'm going to copy and paste this over here just so we have all of the data. This right here, what does this look like? If I just copy this right off a Word doc and put it over here, throw it over here, it's kind of just sort of like a key to look at. Yeah, look at that. I jacked this up though, didn't it? Um, it did. Dang it. Okay, let me just do this. I think I can go like this. Sorry. I'm gonna do this just as there we go. Perfect. And now I get to resize it I want. This is different, right? We're using Excel right now. Forget it. I'll just leave it as it is. Okay. So that's kind of our what you would call a key over here. Less than one. How about that? Did I miss the one? Yeah, I did. Less than one. Overvalued. Now that's clearly less than one. Let me just change this to just so we got it. If I reference this again, sorry, less than one. Okay, pull it down. Less than one. Now the beauty of this is, and I'm going to put this formula back up here again. In fact, um, you guys see that? So I just, wait, that's big enough to see. Excuse me, C2, it's just basically the growth rate, whatever your C represents, whatever your D represents, we're putting those in parentheses, so we're adding them together first, dividing it by the price to earnings to get our projected value. And there you go. Multiplied it by 100 to get that number. So we're kind of just, getting that percentage view of it just by getting that 100 in there. I'll just go take a look here at the chat, make sure we're all on the same page. Good. Yep. You could go either way. Paste in picture. Oh, thank you. Yeah, the picture's nice. Just copy the picture over. Yeah. Well, here's the point. Here's the point that's being made on that. Guys, in case you guys want to save a spreadsheet to do this. Like for example, I could do something like this. Just whatever, you're using over here. This is just kind of a splice, but yeah, I like that idea. Let's go back over here for sure. And I could just do this. Paste it. There you go. So I got the image over here too. I've already got it, but you know what? Let's use that. It's nice and big. Pull it over here. How about that? You can't miss that. All right, we'll pull this off. But that is our key, right? There. Oh, delete. No, I'm not going to delete it. There we go. That's our key. All right. So with this, what we can do is pull this up over here now and get this all lined up. So to get this lined up and to get this really where, the power of the Excel spreadsheet comes in, put the cursor in that bottom right-hand corner right here where you get that thick cross and just push it all the way down. We're going to use this to really get what we're after here. 239. This would have taken a very, very long time to do, but now we're scanning the entire S&P 500 using that Peter Lynch approach to help us out. Wow, a lot of these are incredibly, uh, wait a second. There's one. Yeah, two. There's a three. But going through here can be a real, real pain, as you can imagine. But what I'm going to do now is I'm going to organize this data in place. Let's get that symbol over there. There we go. So I'm going to highlight this information here, all of it. Okay. And there's an easier way to do it, but I'm just doing it very straightforward and deliberately. Just highlight it like this. Highlight all the data. There's actually probably a couple of little tricks in here, but easiest way to make sure we're all on the same page, that is, highlight everything, including these upper titles, if you will, and the columns. Go to sort and filter, custom, and what we want to custom, because we want to see things in really descending order from higher values moving on down to lower values. And I'm going to sort by this column here, which is going to be column H. And it's not, and the cell values are going to be from largest to smallest. Okay. Again, you might just see this over here. Okay. And so click right there, and there you go. Oh, beautiful. So do we have three or higher? We absolutely do. EXE, top of the list. This happens to be a nat gas company, natural gas, biggest producer, I believe, in the US, if I'm not mistaken. You're getting more of these producers. So, by the way, interesting little side note on this, sticking to fundamentals here. This is one area right now that in the Straits of Hormuz, you're not seeing a lot, although you're getting some of the commodity companies coming through. As noted for the past week or so, there has not been any nat gas coming through, which could ultimately lift those values. We don't know. I just had seen that. Wasn't even thinking about this beforehand, but here you go. The ranges, folks, undervalued, overvalued. We have one that's three or higher. We got one that's very close, which is API. I do want to look at these technically as well to see what we've got going on with these companies. Oh, EXE was recently added. Thank you. Lakshmi had noted that here. Uh, Very interesting. Okay. And by the way, I did use Schwab so we could get this data. We do not have this available right here. Estimated growth that I can scan in Thinkorswim, and that's why I used it as opposed to anything else. Now, what we can do is I could import this into a watch list, though. That note was noted in chat. So we can pull this back into a watch list, folks, for sure. So we can view it all that way, and we can click on these real easy. In fact, we would do it just by the symbols. I'll do that next. One thing I did wanted to highlight, though, did want to highlight here as we go through this and talk about this in big scale before we look at these companies. What we're really talking about here is, as I look at the growth plus income. So right over here, growth plus income against how expensive that stock is. Some of these, it's just not going to work. They're just too freaking expensive. Like down here, let's get into some of these PE ratios. There's a 55 on this Eris right there. Do you see it? 55, the PE ratio. Oh, wait, by the way, one cool thing you can do up top, if you go up here, you can lock that that first row. Hang on a second. How do you do that? No, not going to be there. It's going to be data layout freeze. It's called freeze the upper row. It's going to be in one of these here. Sorry. Let's see. Page layout. I want to find it for you. It's helpful because when you scan down, you can kind of see it. Data. No, I know what data. Well, let's see. If you guys know where it's at off the top of your head. If so, let me know. I'll go ahead and freeze it and show everybody. It's not there, is it? No. Am I missing it? Somewhat missing it here. No, 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 no. I'll keep an eye on the chat. Somebody's going to have it. Oh, view. View tab. Thank you. I was thinking view, and then I said it wouldn't be on view, but it is. Right there. Thank you. Appreciate it in the chat very much. View freeze panes, and it just says right there, freeze top row. So again, noted in the chat. Thank you all. Uh, in the chat. Thank you, BJ. Grace, Alaros, BJ, Bogus, right there. Boom, right there. Top row. Lakshmi, you got it. Yeah. So now it's frozen. So now if I scroll down, isn't that sweet? You can come down here and say, well, what was that column? This is really helpful. You have a lot of columns. This one here, L3 Harris, that's kind of a high PE ratio. It doesn't do it justice here, does it? I mean, in terms of the valuation, maybe it's a great company, but maybe not a great price for shareholders. So it's basically saying, hey, how much growth and yield am I getting for the valuation I'm paying. It's fascinating. It's so simple too, right? Higher numbers, you're just getting more projected growth relative to the stock price that people are paying for it right now. Okay, so that's what's going on. Growth plus income relative to what you're paying. Key point. All right, let's take a look at these. And by the way, to do that, I'm going to go ahead and just highlight this, copy it, this row, because yes, I do. I'm going to take it right over here into our Thinkorswim platform. And I'm going to go right in here into bottom left-hand corner, as you guys can see that. Check it out right there. In the gadget window, click on the gadget, click on our watch list, default, create watch list. So the default, I did that kind of fast. Default meaning just to the right of watch list, create watch list. And what I want to do, I want to add a symbol. And why did I want to do that? Well, I do, but I want to import it because I copied it. This is the beauty of this thing. Look at this. Import, paste from keyboard, paste symbols from clipboard. There they are. By the way, it has the very first one, which is the whole column called symbol. It's going to recognize that and say, that's not a symbol. Symbol is not a symbol. There you go. Beautiful. Okay. And we're going to name this. We're going to call it, I'm going to call it PL in remembrance of Peter Lynch. Not that he's not passed away. He's still around, but it's just, that's not the right word, remembrance. Peter Lynch. Valuation, something that you can recognize it with, right? PL valuation. I'm just going to click on save here. Boom. There you go. It doesn't even say, oh, it did see it pulled up this little note. Can't add symbol, fine, but it added everything else. Now, since we have what we want and it put it in the order we were after, we don't have the number over here because it doesn't have the column. And that was the comment made in the chat too. Yeah, that's true. It doesn't have a column that I can plug in here to state specifically, the results or whatever we wanted it to be, the projected valuation. But at least it's what? At least it is in the order from highest to lowest. And so we have a cool reference point. We can just say whatever number we're looking at, these ones, or these top 10 or 15, whatever, are the higher valuations out there. This one's actually up 3 right now. Let's click on it. EXE. Okay, this is a rare. I actually had some lines. We must have looked at this previously. I'm gonna clear these ones off though for now. This is kind of a you don't see this very often at all. And I know Rachel and Ben have talked about this previously. Ben here's in the chat. Great to have Ben here, veteran of the markets. Appreciate you, Ben. And we'll go up top here. Do you guys recognize this? Kind of one of those rarer patterns, I have to say. And it's not, they don't always line up just perfect, but this is what I'm seeing. Ooh, it's going to be about right there. And I'll tell you why, because that line has to touch right there off that top. Yep. It's not the perfect image, but anybody, what is that pattern? It is a rare pattern. You don't see it all the time, but it can be a longer term reversal pattern. Just saying, because we go into technicals, it doesn't have to be, but a lot of technicians would see this as a potential pattern reversal here. Interesting. It just so happens to be, well, evaluation. And do you like what you see here? Dividend yield 2.6, growth rate expected long term 22.3, PE ratio. That is what's putting this one top of the list right there. Yeah, Peter Lynch and a lot of analysts are big. They're big on this. You know, there are a lot of great companies out there. In fact, I've heard Warren Buffett say this. A lot of great companies out there in the market, but remember, we are shareholders. Price does matter. We don't own the company and saying, "Gosh, this is great. All these funds coming in." We don't own it like somebody that might own it at a lower price, or let's say it's a private company. You want it to be like highly valued, whatever the case is, and generating a lot. But we own it based on it's relevant to us because as public shareholders, the share price matters. That's what's making a difference there. But that's coming up top of the list right there. I want to look at APA and a couple of the others too. Look at that. Southwest, really interesting. Okay. It's in the two range, so undervalued, closer to three, but or two and a half. Let's take a look at it. Ben Watson's got it. I tell you, Ben Watson. I knew I knew Ben Watson would get it. The diamond bottom. You see him. There's a diamond top. The diamond bottom's kind of rare. Yeah, you see, that's why there's no. We got Ben. They got it here for it. It's just not a lot. It's just not a lot. You don't see it a ton. And I know Ben has discussed this, and others have as well. But interesting. Okay, so maybe you wait for a change of trend. Maybe break some highs and see what's happening. Right now, it's up about 3.5. APA. Okay, now that's a little bit, that's not a diamond bottom. That's like a longer term upward move with a consolidation and a possible breakout. Folks, it's a lot of fun to bring in fundamentals, isn't it? It's the fun of fundamentals. It is fascinating because you see the growth in their potential. What can the growth do? The growth can provide structure to that technical trend. Higher highs, higher lows. It can. It's not perfect. It's not a perfect correlation, but it can be interesting. Here we go. EQT. I did want to hit love before we're done, or Southwest, and AT&T is too. So there you go. Big move off the bottom. Earnings. What were the earnings on this? What's the component we were just looking at? Projected earnings. Analysts had a projection. Didn't mean it have to be good, but in other words, this one did bounce, and you can watch these for potential reversals. There's your trend line, right? Ooh, that's a good line to. I mean, look at that right off the highs. One, two, three. Gap earnings. A lot of times it is earnings that can reverse some of these moves, right? Let's pull this up. What was it? Because now we have a reference. We have a reference sheet, right? To what we were after. There you go. EQT, boom, right there, 24%. Keep this as a reference relative to your charts. Okay. Now, LUV and T, a little bit of a bull flag right over here. We'll see if that does continue. Probably a little bit of a pullback due to oil bouncing. And there's AT&T too. Again, off these lows. And what are we getting? Maybe that fundamental component side. Folks, if you like this presentation, give it a like. Be sure to follow Ben and I on X. That'll be Ben Watson CS, Mike Fairborn CS. Gosh, that went fast. We are out of time. It is a lot of fun to talk about fundamentals, though. I'm just going to pull this up here real quick, just to show you guys. There we go. Just to show you this. And we've got this over here. In terms of our playlist, you got a lot of great stuff here from Ben Watson himself. Look at that, right up top. Ben Watson teaches a class right there, as you can see, and others, several classes trading index options. This is a swing trade class we did yesterday for clues to finding the intraday swing. If you guys are interested in any of this, what we have here, boy, it's right over here. Great little playlist to follow for sure. Love to have you on board. We got 206,000 subscribers right now, but that is how you do it. Also, last but not least, yes, I did mention it. You can follow us on X, Mike Fairborn CS, Ben Watson CS. Ben's always got some. I love Ben's stuff. I love to check out his stuff from the road. He's on the road. Be sure and check out Ben if he's in your neck of the woods. Just a great presentation broadcast he provides. Ben, here's a little video I did on relative strength. Anyways, we have these little financial things to look at too. All right, everybody, I'll just throw that in the chat. Ben, be sure to put yours in there as well. Have a fantastic rest of the day. It's always fun for filling in for James on this class. My background is accounting and finance. I did look at technicals after, but I like to tap into that because I think provides a lot of insight. Growth, income, value. That's all three in my book. That's the three investing styles, really. Growth, value, and income. PE ratio, capture that income component. When you combine those together, folks, you can get valuations that are interesting. You have to have all three to really kind of get a valuation. That's what we talked about today. You could run something like this on the NASDAQ 100. You could expand the universe of stocks that we were looking at too. We just use the S&P. Doesn't have to be condensed into the S&P. You might look in the Russell 2000 for some growth opportunities in small cap stocks if that's your thing, right? That's right over here. Just want to let you know, doesn't need to be as narrow as what we discussed, like over here in the S&P. Oh, the Russell's right in here. It doesn't even have to be it could even be bigger than the Russell. Just letting you know, we just did the S&P only. Everybody, have a great rest of the day, and I will look forward to future classes with you all tomorrow. Join us in the ThinkScript class if you're interested. Take care, everybody. See you next time.